Okay. And one other question about incorporation. I know you're going to talk about an S corporation in a second now, but we had a question. Can you incorporate in one state but operate or do business in another state?
Yes, that's very common, but you have to read the rules and regulations with that. So you have a lot of people incorporated in states and not in which they live for tax and legal reasons. And again, that's something that they would want to get informed about if it's a good fit for their business model.
Okay. Okay, why don't we go on to S corporations then?
Great. So an S corporation, sometimes referred to, as an S corp, and I like people to think of it as a self corp, and as I go on, they will kind of see why. It's a special type of corporation created through the IRS tax election. It's an eligible domestic corporation that can avoid double taxation once the corporation, and again to the shareholders, by electing to be treated as a S corp. An S corp is different from a traditional C corporation in that the profits and losses can pass through to the personal tax return, your self-tax return. Consequently, the business is not taxed itself. Only the shareholders are taxed. There is an important caveat, however. Any shareholder who works for the company must pay him or herself reasonable compensation. Basically, the shareholder must be paid fair market value, or the IRS might reclassify any additional corporate earnings as wages. Before you form an S corporation, determine if your business will qualify under the IRS stipulations. To file an S corp, you must first file as a corporation. After you are considered a corporation, that's a C corp, all shareholders must sign and file a Form 2553 to elect your corporation to become an S corporation. Most businesses need to register with the IRS, register with the state and local revenue agencies, and obtain a tax ID number. All states do not tax S corps equally. Most recognize them similarly to the federal government and the tax the shareholders accordingly. However, some states, like Massachusetts, tax S corps on profits above a specified limit. Other states don't recognize the S corp election and treat the business as a C corp, with all of the tax ramifications. Some states, like New York and New Jersey, tax both the S corp's profits and the shareholders' proportional shares of the profits. So again, you need tax professionals to help you sort out what is the best fit for you when you're looking at your business structure. Your corporation must file the Form 2553 to elect the S status within 2 months and 15 days after the beginning of the tax year, or any time before the tax year for the status to be in effect. People regularly find this confusing. Just do it as soon as you can. Read more about IRS filing requirements for S corporations. Again, all this information is irs.gov. The advantages of an S corporation is that there are some tax savings. One of the best features is that while the members of an LLC are subject to employment tax on the entire net income of the business, only the wages of the S corp shareholder, who as an employee, are subject to employment tax. The remaining income is paid to the owner as a distribution, which is taxed at a lower rate, if at all. Some expenses that shareholders and employees incur can be written off as a business expense. Nevertheless, if such an employee owns 2% or more of the shares, then benefits like health and life insurance are deemed taxable income. An S corporation has an independent life. It allows it as a business to be separate from its shareholders. If a shareholder leaves the company or sells his or her shares, the S corp can continue doing business relatively undisturbed. Maintaining the business as a distinct corporate entity defines clear lines between the shareholders and the business that improve the protection of the shareholders. S corporations do have stricter operational processes. As a separate structure, an S corp requires scheduled director and shareholder meetings, minutes from those meetings, adoption and updates of bylaws, stock transfers, and records maintenance. A shareholder must receive reasonable compensation. The IRS takes notice of a shareholder red flags like low salary or high distribution combinations and may reclassify your distributions as wages. You could pay a higher employment tax because of an audit with these results. Again, use professionals to help you do your taxes.
Thank you, Lorna. That was a lot of information, and it was great information. I'm going to let you catch your breath for a minute, and we're going to throw a couple of questions here at John.